Greetings. This is the Series 7 Guru. I'm coming to you from my studio here in fabulous Las Vegas. It is time for trade practice test 5. We have 4 up. This is the 5th. First 3 were written by me based on debrief and things people tell me that they wish they would have been better prepared for. Practice test 4 is from Test Geek, Exam Prep LLC. And we took a little poll about whether practice test 5 should be a Kaplan or another Dean Guru practice test. So the poll said we want to explicate a Kaplan. So here it is, Kaplan practice test 5, which means practice test 6 will be 2-3 weeks out. And that'll be another exam that I've written based on debrief and things people tell me they would have wished they would have been better prepared for. Shout out to Kaplan. Kaplan allows my subscribers and viewers and members free look at Kaplan questions. If you're looking for a free supplement to your paid study materials, the best solution is the YouTube channel, my YouTube channel. But if you're looking for a paid supplement, you don't already have a Kaplan QBank, I highly recommend it as a paid supplement. With my Guru 10 discount code for all Kaplan products and services, you can get a Kaplan QBank for about $60. So a very good investment value. All right, let's get started explicating this exam. Now, what you might want to do is pause, answer, and then hit play and see, how your answer compares to Dean's answer. Your customer wishes to lock in a long-term yield. So it kind of sounds like from this, they're interested in not having any reinvestment risk. If you want to lock in a yield, I'm thinking already in terms of suitability, a zero coupon bond, because with a zero coupon bond, you are locking in that yield. A regular bond, remember, every 6 months you're getting paid. You got to decide what to do with money, and that's not going to be the case here. So that's what I'm thinking so far. Minimal risk. So the 2 risks we have in bonds are interest rate risk and credit risk. And so with minimal risk means it looks like they're not willing to take much in terms of credit risk. Long-term yield means they already have interest rate risk, so we can toss that out. So we're interested, that means we're left with credit risk because they already have that with that long-term yield. Not interested in regular income, so sounding more like a zero. Which of the following securities should you recommend? Well, T-bills are just really wrong, right? Because T-bills are short-term. Treasury bill pays you every 6 months. They're not interested in regular income. Corporate A-rated zero coupon bond at Treasury STRIP, which is the U.S. government version of a zero coupon bond. A-rated could soon be BBB, perhaps. So I'm going to go for the Treasury STRIP is the answer on this one. Losses from direct participation programs can be used to offset. So, you have 3 baskets of income. I recommend, no surprise, my lecture on taxation. You have paycheck income, you working for money, your earned income. You have portfolio income, your money working for you, unearned income. And then you have partnerships, direct participation programs, and that's all passive. And so losses from partnerships, passive losses, can only be used to offset passive income. Now, what happens in that partnership area is going to stay in that partnership area, right? So the term tranche is the French word for slice. If you give something a fancy French name, you can charge more for it. You're not getting much for, snails with butter, but escargot and beurre, now you're talking. And so what structured finance men and women do is they buy a portfolio of mortgages from Ginnie Mae, and they carve it into various cascading cash flows called collateralized mortgage obligations. And we have 2 versions of these cascading cash flows. We have what are called PACs, plan amortization classes, and targeted amortization classes, and very testable to know that plan amortization classes have less risk and more predictability than targeted amortization classes. Also very testable to know that the buyer has to sign a suitability statement, that they understand they're not buying proportional ownership in a pool of mortgages, but rather a cash flow from a pool of mortgages. An investor purchased one XYZ 50 call for a premium of 4. So that's called an opening purchase. That's dollars out. On expiration, the stock is selling for 62. The investor closes out for intrinsic value. So remember, the intrinsic value, we're going to do a closing sale here, would be the difference between 50 and 62. So that means I bought it for 4 and I sold it for 12. And so that means I have 8 points. I do it in points per share. I have an $800 gain. So be careful on this one. Ordinary income, remember, is my paycheck income. It's going to be short-term capital gain, which is taxed at my ordinary income tax rate. But this is taking place in that basket we call portfolio. A moral obligation bond. Well, moral obligation bonds are a type of municipal bond. So I should have been able to toss out U.S. government. This is where the state says, if they don't pay you, the state will take a vote and then we'll decide whether to pay you, right? I use a rural hospital. The John C. Fremont Hospital asked the state of California, would you be morally obligated to pay these bonds? If you bought the bonds on the confirmation, it would say John C. Fremont Hospital Revenue District bonds, comma, a moral obligation of the state of California. And if they default, then the legislature of California takes a vote and says, all in favor of paying back the John C. Fremont Hospital Revenue bondholders say aye. All opposed say nay. More yeas than nays, you get paid back. That's called legislative apportionment. So the answer to this one is B as in boy. B as in boy. Which of the following is not generally associated with an existing real estate direct participation program? So existing, not. Well, I do think we have, I'm going to do process of elimination here. I have a known history of the income and expenses in the property because it's existing. So I know what the rental income stream is, right? And I know that's C, and I know what I've spent to maintain the property. So it's much easier to kind of project what return will be. And it has lower risk certainly than raw land, appreciation potential. You're going to get some, but that's not going to be, if you wanted appreciation potential, you'd go for raw land. So the answer is A, by process of elimination. Market timing is normally associated with which of the following portfolio management styles? So, we have tactical, which means we're going to be a little more aggressive than strategic. And so tactical, I joke, when I was in the Marine Corps, I was in intelligence, but the intelligence of the Marine Corps is tactical. It's a little more short-term, like what's behind that tree, right? With which of the following? Market timing. So we're going to be a little more aggressive, by the way. It's going to have more cost to it because we're buying and selling as we rotate in and out of things. It's going to be less tax efficient, but that's called tactical asset allocation. Which of the following risks would least impact a CMO? Which of the least impact a CMO? Well, we should know that we have extended maturity risk because, these are a cascading cash flows from a mortgage pool. And so if interest rates go up, this thing will extend in its life. We have prepayment risk, which least impact. So that A and C are certainly there. Liquidity risk. Yeah, I'm not sure what they mean by least impact here. This one, I think I'm going to go between, I'm stuck between B and D. I'm trying to decide whether I want to say that it's a thinly traded market as compared to other things. So yeah, I'm stuck here between whether I want to pick rate risk or liquidity risk. I'm going to say liquidity risk just because rate risk, I think, would mean, the mortgages are changing. I might miss that one. We'll see. Question 10. One of your customers has established a long position in ABC January 50 calls. Which of the following details would not be on the confirmation of the trade? The premium is certainly going to be there. The name of the underlying security is certainly going to be there. The exercise price and expiration month. Yeah, we don't put like if it's a 140 call that is $14,000. So the aggregate exercise price is not on the confirm. All the following may be cited to justify a markup on a stock sold from a broker dealer's inventory, except. So, got to be careful on this one. The overall value of the transaction, the availability of securities price. Yeah, my dealer's cost is, it's got to be a competitive price, not on what my dealer cost is. I mean, that would mean, I'm never going to lose money on my inventory, right? So the answer here is going to be A. An investor purchases a municipal bond for a yield of 5.5% to maturity. 2 years later, he sells the bond with a price equivalent of 5%. So that means somebody must have paid me a higher price, because right, yield goes down, price goes up. And so it looks like I'm going to have a capital gain, and that's certainly going to be taxable. So if the yield got knocked down from 5.5 to 5, knocked down, that means the price went up. And so it looks like I've got a capital gain there. Remember, the only component of muni bond that's tax-free is the coupon. If you buy the muni bond low, you sell it high, you're going to have to pay taxes on that. A preemptive right. So our preemptive right is our first right of refusal on the issuance of new shares. It's our right to maintain our proportionate ownership in the corporation. I would definitely know that rights are short-term and exercisable below the current market price at issuance. I would definitely know that the rights offering is the mechanism used for this. And I would know that a customer can either trade the rights, exercise the rights, or the rights may expire. I would know that a standby underwriting may be used in a rights offering to make sure the shares get distributed, and to make sure you can contrast rights with warrants. As I said, rights are short-term and at issuance, exercisable below the current price to give you an incentive to participate. And then rights are long-term and exercisable above at issuance. So make sure you can contrast those as a test taker. An initial public offering is conducted in the secondary market. No, usually IPOs are going to be primary transactions. A New York Stock Exchange, now that's our secondary transactions. Directly with principal shareholders, nope, that again would be a secondary transactions. Yeah, usually the issuer is going to go through an underwriter to help them to make sure we're in compliance with what's called 33. 33 says you're going to sell brand new securities to the public. You have to provide people a prospectus. A corporate bond pays interest. So that's important. It's a corporate bond, because remember, corporate bonds and muni bonds use 30-day months for purposes of calculating accrued interest. And you need to know corporate and muni bonds are T+2. So it pays interest on a J&J 15th. That means it pays interest on January 15th and July 15th. So you purchase the bonds on Friday, April. Let me get out my annotation tool here. You purchase the bonds on Friday, April 17th. So 18th, 19th are a weekend. So Monday is going to be the 20th, right? So they're going to settle on Tuesday, the 21st. Tuesday, the 21st. So January, February, March, April, 4/22. So 4/22 is when the bonds settle, right? Because Saturday's 18th, 19th, 20th. Oh, let's be careful here. So it looks like I made a mistake. I haven't had anybody in a long time tell me they've had to actually calculate this in a long time. But let's see. So 18th and 19th is Saturday and Sunday. 20th is going to be Monday. That's T+1. And Tuesday is going to be the 21st, right? So 18, 19, 20, 21st. And then it's last paid interest on the 15th. And so what I like to do, I call this the shortcut. So now I'm just going to subtract. 15 from 21 is 6. And 1 from 3 is 3. 1 from 4 is 3. So 3 months and 6 days, which is choice C here. But you calculate this up to, but not including settlement. Just be careful, though. If you're going to use my shortcut, then you actually use the settlement to actually do that. A high net worth investor, let me clear up my screen here. A high net worth investor with substantial annual income likes real estate as a potential investment. The investor notes that any investment potentially offering tax credits would be most interesting to consider first. Which of the following would be suitable investments to discuss? I like this. You need to know a credit is a dollar for dollar whack out of your tax bill. And this is an aim and shoot point and click test question. So boom. make sure you do that. I hope when you're doing these practice tests that you have a stack of 4x6 cards or a stack of notes where you can take notes, particularly on these questions I'm telling you that are very high probability that you will encounter. A customer buys one FLB October 50 call at 3, and she exercises the option to buy 100 shares when the market is 60. For the most part, cost base follows break even. There are exceptions to that. But by the way, it doesn't matter the stock is 60, right? If I exercise, I'm buying the stock at 50, that's 5,000. I paid 300 to be able to do so. And so my cost base, remember cost basis means when I turn the money into the investment. So $50, $300. There's exceptions to what I just told you, but for the most part, when you see cost basis, if you do the break even for the most part, that would end up being the right answer. All the following statements regarding the over-the-counter markets are true, except you should definitely know that the OTC market is not an auction market. The auction order-driven market on your exam is exchanges, not the over-the-counter market. A bid is the highest price a dealer is willing to pay. Yeah. As a dealer or market maker, I buy at my bid. That's true. Securities trade over the counter include ADRs and municipal bonds. Yes, that's is true. All bonds trade over the counter. The offer is the lowest price at which a dealer will accept when selling. Yes, as a dealer or market maker, I sell at my offer or my asking price. And so the answer is A. An investor closed a brokerage account with a FIN member firm on May 12, 2017. Almost 4 years later, the same investor has a financial plan developed by a registered rep of a different firm. While examining the old accounts, the representative discovers a transaction where the individual handling the account, as well as the member itself, was negligent, resulting in a loss of $100,000 to the customer. That transaction occurred on April 30th. If the investor wished to make an arbitration claim, now this is way overboard on the test. You just kind of know there's a 6-year statute of limitation for arbitration. So, you don't have to really know it at this depth. So all you really need to know is that this is past the statute of limitations 6 years from the date of the event, which is choice A. I wouldn't worry about all this gobbledygook here. I would just know it's 6 years as a name and shoot point and click question. Each of the following choices are potential sources of funds associated with backing of a revenue bond, except. So each of the following choices are potential sources of funds associated with the back of a revenue bond, except. So our choices are lease payments, ticket revenues, fines, and concessions. So, we got to decide which one of these we think goes into the general budget, which one of these we think goes into the general budget of the municipality, and therefore would be GO bonds and not revenue. So I think the one I think that's least likely to be a revenue bond is going to be the fines. I think of here like tickets, police officers, you run a stoplight, they write you a ticket. That typically goes in the general budget. I may miss that one, but I'm going to go with C. Lease payments, we definitely go with a revenue bond. Ticket revenues, and maybe that's different than my fine. Concession would be, people who pay the city to, lease a property for a business purpose or something like that. But I'm going to go with fines. When opening a new account for an individual investor, FINRA asks its member to make a reasonable effort to obtain certain information about the account, including would be all the following except. We definitely need the tax ID number. We definitely need to know whether you're associated with another person. We definitely need to know the occupation. What we don't really need to know is your dependents. I mean, from a financial planning standpoint, perhaps, but not actually a part of the new account documentation. The principal tax benefit of investing in an exploratory oil and gas drilling program is derived from, so exploratory is a wildcat kind of program. We're going to go places other cats don't go. And we're hoping to find some oil. And so, unlikely we're going to end up with recapture. Very unlikely we're going to have depreciation. Depreciation is for things that have a useful life. Oil and gas tax benefit. We definitely want capital appreciation as tax benefit. So tax benefit, recapture is not a tax benefit. Depreciation is. Intangible drilling costs like the geological survey, that kind of stuff. D is a tax benefit associated with wildcat oil and gas. Which of the following would not be considered institutional communications with the public? Now, I would definitely know what is those three baskets. The three baskets are institutional communication, retail communication, and that's for more than 25, and then correspondence was 25 or fewer. And the main test question is to know that retail communication requires principal approval, pre-distribution, whereas correspondence, it's pre or post. Now, this is about institutional communication. On the test, we're less concerned with that. So our choices are a communication to an individual not be considered institutional. A communication with an individual. Institutional people are not living, breathing human beings walking planet Earth. So I kind of like A so far. Let's look what the rest of our answer set says. Another to another broker dealer. That sounds like they're capable of protecting their own assets, their own interest. A letter to an issuer. Yeah. An internal memo promoting a new product offered. Yeah, I think given that answer set, it looks like A is the Joe Sixpack retail investor there, and therefore not institutional communication. An investor has researched XYZ Corporation, as convinced the company's stock will soon decline. If the investor wishes to act on that conviction with investment strategy, so first thing I'd say here is I'm bearish, right? I'm a bear, so I'm looking for something that bears do. Which investment would take advantage of the decline with the smallest cash investment? The smallest cash investment. So, I always consider people who buy puts to be smart bears, right? Because if you buy a put and you're wrong, you just lose your premium. Purchasing a call spread is a debit call spread, that's bullish, so that's out. B is bullish, that's out. C is bearish, but you would have to come up with half of the market value, right? Zoom yesterday was a $90 stock. If I short 1,000 shares of Zoom at 90, I'm going to have to come up with $45,000. But to buy a 90 put on Zoom, I just have to pay that premium. What is the term for the segment of the over-the-counter market where firms that are not exchange member can make markets and trade securities without going through a physical exchange? That's called the third market. The third market can best be characterized as listed securities traded over the counter. So the answer is A. The fourth market would be direct trading between institutions. So that would have been C. So this answer is A, the third market. Which of the following strategies and consider most risky in a strong bull market? Well, listen, ladies and gentlemen, you should definitely know that naked calls subjected to unlimited risk. None of those other things are going to subject you to unlimited risk. And, writing naked puts, that's bullish, right? So, this says bull market, that means you're a bear. So we're looking for something the bears would lose money doing. Bulls A, B, and C are all bullish. So you should definitely know that naked calls, that's writing a call on stock you don't own, naked or uncovered calls, subjected investor to unlimited risk. An investor interested primarily in speculation does not expect the price of DWQ stock to change. So, in option strategies, you're either buying volatility or you're selling volatility. So here I'm saying, okay, I think I'll sell the volatility on the stock because I think it's going to stay where it's at. And so, there are 4 questions about a straddle. One question is, can you identify a straddle? Can you calculate the break evens? Can you determine where it's profitable? And this one is, when do you use it? You write here it says write a straddle short the stock and buy a straddle. No, buying a straddle means you want it out to move. You think it's going to go way up or way down. Write a straddle and buy the stock. No, it looks like what we're doing is just going to short a straddle there. Which of the forms of soft dollar compensation paid by a broker dealer to an investment advisor? We love as broker dealers, investment advisors who direct their trades to us and use us as a broker dealer for custody. And so if we can help them help their clients, we're all about that. We're all about that. So, they say, hey, Dean, as an investment advisor, we do a lot of business with your broker dealer. Will you pay for research reports for us? They say, absolutely. That's soft dollars. I'm more than happy to take care of that for you. And it's soft dollar compensation to the investment advisory firm. Financial planning software, and let's look at other ones. Registration fees to attend an investment seminar, absolutely not a problem. D, reimbursement for meal expenses incurred while attending the investment seminar. I think that's more problematic, by the way, than financial planning software. Let's see if I get that right. I'm going to go with D because that sounds a little more problematic than B. And I don't like the financial planning software. I can make an argument that that would help the investment advisory firm help their clients. Remember, their clients are my clients on the broker-dealer side. Under SEC Rule 10b-13, a company that is a target of a tender offer must provide its shareholders with a statement indicating acceptance or rejection of the offer within how many business days of the announcement. This is going on right now. You know, Elon Musk has made a tender offer to Twitter. And so this is asking how long does Twitter's board have to respond? Right now, I'm coming to you at a time when JetBlue has made a tender offer for Spirit Airlines. And so that answer is 10 days. By the way, it would be 20 if they asked you the person who made it, right? So here it's saying the target, that's the company that, you know, that we're making the offer on, Spirit or Twitter. If I asked how long does Elon have to leave his tender open, or how long does JetBlue have to leave it open, that would have been 20 days. A customer wishes to open a new account, but refuses to provide suitability information. Under FINRA rules, the member must not open the account. No, may open the account, but must limit recommendations to U.S. government securities. That's kind of odd. May open the account, but must limit recommendations to investment grade. May open the account, but any recommendations must be, yeah. So if I have other ways of determining suitability, by the way, that's my 30-minute egg timer. You know, these explications go quite a while. And so if you want to take a break and hit pause, what I try and do is tell you when it's been a 30 minutes so you can decide, you know, whether you want to step away and come back and do it. Anyways, D sounds like the best choice here. May open the account, but any recommendations must be limited to suitability information that we're able to obtain. So, you know, I joke, right? I'm going to open the account for Elon, and if he refuses to give information, I'm going to put suitability, richest man in the world. D. All the following statements regarding customer confirmations are true, except. So that was the 30-minute button, by the way. So if you want to take a break, you know, welcome back. You know, I'm going to continue to march, and I'll probably take a break at some point as well. All the following statements regarding customer confirmations are true, except. The confirmation must disclose whether the broker-dealer is a market maker in the security sold. The customer must receive the confirmation no later than the business day after the trade date. That's false. It's by settlement. True, except. So I think I got the answer here. The confirmation must disclose commission. We acted an agent. They'd see that's called capacity. It must disclose a control relationship. Yes. I joke, if you're a Merrill Lynch broker and you sell somebody Bank of America, on the confirmation, it will say that there's a control relationship between Bank of America, the issuer, and the broker-dealer Merrill Lynch. And remember, this is except, and remember, confirmations go out by settlement. So I'm going to say B, no later than the business day after the trade date. No, it's by settlement, which in stocks, corporates, and munis is T+2. Which of the following pooled investment vehicles would most likely be structured as a limited partnership? Yeah, hedge funds are structured as private partnerships. And the hedge fund manager is typically the general partner, and then the investors in the hedge fund are the limited partners. And remember, that means hedge funds don't have liquidity. And then remember, the other thing is, I just said private partnerships. That means that hedge funds are typically offered as private placements. And so that means to participate in a hedge fund, you're going to need to be an accredited investor. One of your clients has a margin account with the following balances: long market value of 50, debit balance of 40, short market value of 40, credit of of 65,000. So what we're going to do here is we're going to say that 30% is 25% is minimum maintenance on the long account, and 30 is minimum maintenance on the short account, but it says maintenance level. So what I'm going to do here is I'm going to take 24 grand, And the way I do that is to I divide by 0.75 and I get $32,000. You should definitely be able to take the $32,000. So I now have a 50-50 because it's either A or B. So I took the debit register and I divided by 0.75. You should definitely be able to do that. Now, the next thing I'm going to do, market value maintenance. Please note, it didn't ask what is maintenance. It said when. So the next thing I'm going to do is take the credit balance, which is 65,000. And I'm going to divide by 1.3. And I get $50,000. So the answer is A. So I would definitely be able to do market value at maintenance, Which of the following are true? Build America bonds are tax exempt at all levels. Direct payment, Build America bonds provide municipal issuers with payments from the U.S. Treasury. Build America bonds are issued by the U.S. Treasury. Roman numeral 4, tax credits. Tax credit of the issuer provides the municipal bondholder with a federal income tax credit. So the answer here is 2 and 4. Direct payment, Build America bonds provide the municipal issuers with payments from the U.S. Treasury. And 4, the tax credit of the issuer, Build America bonds provide the municipal bondholder with a federal income tax credit. I haven't had anybody in a long, long time tell me they've seen anything about Build America bonds on the actual exam. Many investors diversify by adding foreign securities to their portfolios. Those who do so with American depository receipts are least likely to be concerned with. Now, I don't like the grammar in this question, but, least likely. You should definitely know that ADRs do subject you to currency risk. So I don't like the phraseology, but I think I'm going to say D here because least likely. Do I have political risk, market risk, liquidity risk, currency risk? That seems like my best choice given that answer set. So I'm tempted to take currency risk, but I'm not quite sure the grammar here. Are least likely concerned with. So I'm just looking, I think political risk. When I get these questions, I think of an example in my own mind. I say, okay, let me go to my brain and housing group and think about an ADR like, for example, Teléfonos de Mexico. Teléfonos de Mexico, am I worried about political risk? I certainly am. I mean, right now, the presidente is a guy named AMLO, and, he's not a capitalist-friendly kind of guy. I'm definitely afraid of market risk, the Mexican bourse, the Mexican market. I'm certainly concerned with currency risk, turning the pesos into dollars. So I think I'm going to read this least likely, like, the opposite. And I have liquidity, right? Because I can, buy and sell the ADR. So I'm going to go with C. That's kind of a funky grammar-wise, but I'm going with C. In safety of principle, general obligation municipal bonds are considered second only to. Well, corporations have to deliver products and services at excess of raw material and labor. They can do that. It's called a profit. If not, it's a loss. And capitalism without failure is kind of like religion without hell. And so, corporations are not considered safer than geo-muni bonds, where there is a taxing authority. They can confiscate money. So both municipalities and the U.S. government can confiscate money. So they're considered second only in terms of credit quality in general, all things being equal, which they never are except on the test, to U.S. government and agency bonds. By the way, you could have perhaps gone with the Sesame Street on this one. One of these things is not like the other. If a customer wishes to change a day order to a GTC order in the middle of the day, the registered rep should A, enter the new GTC order immediately and do nothing about the day order. B, enter a change notice immediately. C, enter the new order as GTC and immediately cancel the day order. Allow the day order to expire at the end of the day and put in the GTC good till cancel before the next day's opening. So I think the most prudent thing here is to allow that day order to expire, right? And then we put it in GTC the next day. That way we don't have any kind of, problem with ones running into it. Remember, it's already a GTC today, so there's no need to try and do anything to it because that already exists on the order book. So D seems like the best answer. Allow the day order to expire at the end of the day, and then the next day we start fresh. When a firm commitment underwriting, within a firm commitment underwriting, the document that details the responsibilities and liabilities of each firm. So the agreement amongst the underwriters. Yeah, that sounds pretty good. That's also known as a syndicate letter. That sounds pretty good. The underwriting agreement, no, the underwriting agreement is between the issuer and the syndicate. Letter of intent, no, that's for mutual funds. Registration statement, no. A. Now remember, in a firm commitment underwriting, we're acting on our dealer principal capacity. As far as the issuer is concerned, that stock is sold. So I would definitely, as a test taker, be able to contrast a firm commitment underwriting with a best efforts underwriting. Anyways, the answer to this question is A. The manager of ABC Municipal Securities is interested in bidding on some general obligation bonds. So this is a competitive underwriting that will be available in the coming months. Where would the manager find information about these forthcoming issues? So, as the daily racing form is to people who bet on ponies, so is the bond buyer to people in the municipal bond market. The bond buyer is a newspaper widely read in the municipal market, and in there we would have what's called the notice of sale. The notice of sale is, attention investment bankers, we're looking for some help in underwriting our bonds. A fund aims for consistent total returns. The management is empowered to shift assets among stocks, bonds, and short-term fixed income. You could toss out right away choice A. It's not an index fund because we don't change the portfolio. Because of its ability to diversify amongst its many investment instruments, the fund has the potential to provide maximum returns while reducing volatility. The information describes which of the following mutual funds. Well, we've eliminated the index fund already. We can eliminate the KPL government income fund. And so it looks like it's going to be B or C. It looks like C would be the best choice here, given that the capital appreciation thing, I'm thinking stocks. So I'm going to go with C. I might miss that one, but let's see if I get that one right. When a municipal bond has a net revenue pledge, this is very testable. What is the first item that gets paid? So net revenue pledge, the operations and maintenance fund has priority. That's very testable, this question. And that's going to be found in what we call the trust indenture. The trust indenture is where we find the covenants or promises. And so the answer is C, the operations maintenance fund. If it was a gross revenue, we would assume net revenue, and that's the high risk one on the test. If it was gross, it would be A, but here it's C as in Charlie. A customer has a non-qualified. So as a test taker, I hear non-qualified. I think after tax money. I'm funding the variable annuity with money I've already paid taxes on. Now, the neat thing about a variable annuity is when I annuitize and turn it into an income stream that I can't outlive, that's pretty cool. Some of that money coming back to me is money I've already paid taxes on. And so part of the return of my original money, I'm going to owe taxes on, and then I'm going to owe taxes on the difference. So the answer is A. An investor with no other position buys a 75 call at 6.5. If the investor exercises the call with the stock at 77, there's a lot of ways to proceed here. One way you can do, I like to do T's. You could just memorize break evens, whatever floats your boat. So I'll just make a T. And I use dollars out on the left side, dollars in. So I bought this call for 6.5. And so I exercise the call, which means I bought the stock at 75. And then it says with stock, I sell the stock at 77. And so it looks like I've got more money out than in. Now, what you could have done is just done your break even, which is 81.5, and said 77 is, 4.5 points in the wrong direction, right? So you can net these columns and say my break even. You can just memorize break even 81.5. I'm terrible at arithmetic, by the way. So I'm going to just make sure that my arithmetic is correct. 6.5 plus 75. 81.5. Yep. So 4.5. I do things on a per share basis. So, I'm not going to put 650 bucks there, 7,500, 7,700. I just think that's a mess. I have 20 hours of options lectures for you. in the Series 7 playlist. I think you shouldn't have any excuse for not having access to all the resources you need in options. All the following may be included in an advertisement for a CMO, collateralized mortgage obligation, except, yeah, this is kind of an interesting kind of an answer set. A disclosure that the CMO's coupon rate and final maturity date, that's choice A, a statement that the CMO is guaranteed by the U.S. government. Now, well, that sounds iffy. The portfolio that we carved up, the Ginnie Maes, but the cash flow from a generic description of a CMO tranche, a disclosures, the assumptions may or may not be met. Now I know for sure D is going to be part of that, and this is asking me the accept format, right? The accept format. Yeah, I think a disclosure of the coupon rate, I'm just looking at this. I think B is going to be the misleading thing here, right? Because can you lose money on CMO? You can. It's not going to be because of credit risk, but it's going to be interest rate. It has major interest rate risk. And so it sounds to me to say that the CMO is guaranteed by the US government would be a misrepresentation. A generic description of the tranche disclosures, I'm going to go for B, because remember, it's the underlying portfolio of Ginnie Maes that have the full faith and credit of the United States government, not the cascading cash flow from that. It's a derivative security. An investor owns 400 shares of common stock. ABC's board of directors has declared a 5-4 split. As a result, the investor will receive how many additional shares? How many additional shares? So what I would do is I take the 5 divide by 4, because that's what 5 means, 5 divided by 4, and I get 1.25, and I have 400 shares. I'm going to times that by 400, and it looks like I'm going to now have 500 shares. So I started with 400, now I have 500, and they're asking me how many additional shares. So I'm going to go for 100. So what I did again, the math I did is I took the 5 divided by 4, and then I multiplied by my share position, which was 400, and I got 500 shares. Now remember, that's choice A, but it didn't ask me how many shares I got. It says how many more shares am I going to get? So the answer is B. As the price of the VIX is testable. So the VIX is known as the fear index, and it has a negative correlation with the market. As the market goes down, the VIX goes up. So as the price and the volatility of VIX rises, investors should expect, so you should expect a decrease in the call premiums only, call and put options to rise, call and put options premiums to fall, a decrease in put premiums only. Now, you're definitely going to see something on the VIX on the test. I'm not sure this is the one you'll see, but you'll see something on the VIX. So I think to a certain extent, both of these are going to go up, right? I mean, because if volatility is increasing, the options market are going to be more active. And when you're buying volatility, you're going to pay more for the premium. So I'm going to say that I think both of these are going up. Now, I think the other thing you should be aware of here is I can use the VIX to hedge my stock portfolio, right? So I can buy calls on the VIX, and if the market comes down, I'm expecting my call contracts to become more valuable. Which of the following have a low beta? Very testable. Beta is a measurement of volatility as compared to the market as a whole. And, I think of a low beta being kind of boring, less reward, but also lower risk. And it looks like all of those, I'm going to pick public utility. Aerospace are cyclicals. So technologies usually have a higher beta. Software has a higher beta. Aerospace is cyclical. So given that answer, I'm going for D. I would also know that public utility stocks are also defensive. They deliver products and services resilient to the business cycle. An investor submits an immediate or cancel order to sell 100 shares. So they want to sell 500 shares at 32.20. So that's a sell limit. I'm going to have to match them with a buyer. So if my customer wants to sell, I'm going to match with a buyer. When the order reaches the trading form, the quote is 32.18, 30.18, 32.26, 6 by 6. So that means somebody is willing to buy 600 shares at 32.18, and somebody's willing to buy 600 shares at 32.26. Let me get out my annotation tool here. let me get a small font here. So this is the bid in the auction right now. And this is the ask. And right now the customer wants to sell at 32.20. I said, well, sorry, there isn't 32.20 there. There's 32.18. And you said immediate or cancel. And so it looks like you're not going to sell any shares because you would have accepted partial execution here, but it doesn't look like there's anything available. So you didn't sell any shares because you said you want it all. You want to sell, by the way, you got to get comfortable with this. So you're selling, you want to sell at 32.20 as a seller, your price or more, and there's not somebody there. So it looks like you didn't sell any shares. Let me clean up my. A market order purchase 100 shares of XYZ. You should definitely know that market orders are the only orders that has no qualifier, no contingency, right? So order to buy 100 shares. A market order is executed the lowest price of the day. Good for the day only. Executed the market close. Valid at the stipulated price. I don't really like this answer set, but given this answer set, it looks like the only answer that's viable is B. So yeah, I'm not a big fan of that answer set, but I would know market order is immediate execution, best available price. In a partnership agreement of a limited partnership, all the following would be disclosed except the procedures for the annual election of the general partners. What? How the general partners will be compensated, how the operating profits will be distributed, what matters the limited partners can vote on under democracy provisions. Yeah, we don't do an annual election of the general partner, so I'm going to go with A. The rest of the things sound like something we would want to know in the partnership agreement. How will the general partners be compensated? Yeah. How will the property be distributed? Yeah. So I'm going to go with A. I might miss that one. I doubt it, but let's see if I miss that one. New issue municipal bonds are allocated according to priorities the syndicate sets in advance. The MSRB requires syndicates to establish priority allocation for orders. Which of the following is the most common priority? I haven't seen anybody say they've seen this in a long, long time on the test, but it used to be there all the time, and I don't share it anymore as a memory aid device. Pro golfers don't miss, or pretty girls date more, or pretty guys date more. And the reason I don't share that in my test taking tips, tricks, and memory is just because I haven't had anybody see it in a long time, but it's B. Which of the following are considered joint accounts? It looks like an UPMA account. That's not a joint account. That's one minor, one custodian per account. Guardianship certainly isn't. It looks like 3 and 4. You should definitely be able to contrast tenants in common where there's a fractional interest and the decedent share goes to their state or beneficiary with tenants and rights of survivorship, where there is no fractional interest and the tenant decedent share goes to the surviving parties. So 3 and 4. A customer purchased a full faith and credit bond. That's a layup. The bond would be known as, I suggest you get a sheet of paper and fold it in half. And on one side, write all the terms associated with GO bonds. And on the other, all the terms associated with revenue bonds, because that's a big part of the exam is distinguishing between GOs and revenues. And full faith and credit, the issuer is going to be a general obligation bond. C is in Charlie. An investor is looking to add fixed income securities to their portfolio. A registered rep should suggest either the ABC, that's the issuer, 6s, that's the nominal yield, fixed or stated rate of return coupon, 2050, that's the maturity or redemption date. Or the XYZ issuer, 6s of 2043. So they both have a coupon of 6, and it looks like one is matures in 7 years later than the other. Should there be an increase in market interest rates? So I like this one. Market interest rates, it looks like long and low. So it looks like the ABC 6s is going to have the most volatility because it's longer term. So the XYZ bonds will suffer a price decline that's greater. No, remember, it's going to be the ABC bonds. The ABC, there we go. Right. So longer term maturity, longer term bonds are more volatile than shorter term bonds. And then the inverse relationship, right? Interest rates go up, the bond price goes down. When must a Reg T call? We don't tell customers this, but the customers get 2 additional days. Reg T is set by the Federal Reserve Board. In regular way settlement, T plus 2 is between broker dealers. And so customers get 2 additional days. And so that's going to be 2 and 3. And by the way, customers in cash accounts get upset sometimes. I, as a margin clerk, reach out to you. I got a cash account. I go, well, I'm sorry, even in a cash account where you intend to pay in full, I, the margin department, determine whether monies or securities are due. And in a cash account, that's T plus 2, which is 4. A customer sells a 0 coupon bond for maturity. The gain or loss will be the difference between the sales proceeds. Remember, you have to do straight line amortization upward. There's an imputed interest you're receiving, and that's called your accreted value, right? So it's going to be A. An investment advisor who switches among investment classes upon anticipated market changes is using a technique known as dollar cost averaging and value investing, indexing, no, asset allocation. Yeah, you're changing it. It sounds like D is my best choice there, right? A customer wants to place an order for a specific municipal bond and provides the bond's issuer, coupon, maturity date, and CUSIP, but she has not disclosed her financial objectives or tax status. What should the representative do? Well, recommend a different bond. How can we do that? Transactions refuse the order? No, we're going to mark the ticket unsolicited. I mean, that's his or her idea. So we're going to execute the order and mark it unsolicited. Which of the following would have the least impact in marketing a municipal bond issue? The dated date is the date the bonds start to accrue interest for the next time frame. So, maturity would certainly do that. The rating of the issuer, the size of the block. Yeah, larger blocks of munis are more marketable than smaller blocks. So I'm going to go for the dated date and say, when it starts to accrue interest is the least important thing here in the answer set. A double barrel bond has 2 pledges. Double barreled, hence the term double barreled, 2 pledges. A bond that has the principal and interest backed by the revenues of the facility and the general taxing authority of the municipality. You should definitely know this is a type of muni bond. And that sounds awful good. The one I use is Salt Lake Olympic Organizing Committee revenue bonds, a general obligation of the city of Salt Lake. So A. I have several good muni bond lectures for you. A customer buys 100 shares at 52 and at the same time sells a hex call for 4. So as a margin clerk, I say the margin call, let me get out my annotation tool here. We're buying $5,200 worth of stock. Let me get a bigger font for this. 5,200 times 50%. So on that part of the transaction, you owe me $2,600. And that's your Reg T margin requirement. That is not your margin call. So be careful what you're being asked here. And then it says, I'm trying to get some room here. Then it says we sell a hex call for 4. And so that's already in your account. So we're going to be able to deduct that. And so I'm going to say, well, listen, you need $2,600, but I already have $400 in your account. So send me $2,200. So the call is the difference between what you need, $2,600, and what you've got, which is $400. So the answer here is D as in dog. D as in dog. Let me clean up my slide. A customer is long 200 shares of MTN at 30 and 400 shares of DWQ at 20 in a margin account. The debit balance is $8,000 and the customer sells 200 shares of DWQ for $4,000. The credit of the special memorandum of the account. Don't overdose on margin. On margin, there's only 3 or 4 margin questions. So, and all the test prep providers go way, way overboard. So let's see. I'm going to figure out what my long market value is because I know you need to know the classic margin equation. So 200 shares times 30 is $6,000, and 400 shares at 20 is $8,000. So 6 and 8 is $14,000 in long market value. And then it tells me that the debit balance is 8. And so that means I have $6,000 in equity. And that is called the classical margin equation. Well, I would definitely know the classical margin equation, which is long market value minus debit equals equity. So I just want to make sure I did the math here. 400 times 20. Yep. And 206. Yeah. All right. So then what I always want to do as a margin clerk, I want to see if perhaps I can't loan you more money. So now I'm going to compare that to Reg T. And that Reg T is coming from half of the market value, right? 50% of 14 is 7. So, right now you have less than 50% equity in your account. Nobody's going to bother you here. But actually, that's another 30 minutes. So we've been at an hour. If you want to take a break, now would be the time to do so. But we want to notice here is that we are restricted. We're below 50% equity. Now, nobody's going to bother you here, but you are indeed below 50% equity. And so what I'm going to put here, that's how much below we are in terms of this account. Right? Okay, so that's important. So now the customer sells 200 shares for $4,000. So in a restricted account, when you sell, you can only have half the proceeds. You have to leave the other half of the account to pay down the loan. So here I'm only going to send you $2,000, but if I told you that and you said, gee, Steve, if I don't get it now, I don't think I'm going to be able to get it. I say, no, I'll tell you what I'll do. I'll credit your SMA. This is the only time, by the way, I'm going to make a direct entry into the SMA that is not a function of a mark to market. And so I'll tell you what I'm going to do. I'm going to credit your SMA. I'm going to make a special memorandum to your account for the $2,000 you could have got, but chose not to in this restricted account. So, by the way, if you were going to do the mark to market, you could miss this very easily because you could have said, okay, well, we sell 4,000. So that goes to 10. I'm just showing you what this looks like now. If you actually sold the stock and did the mark. And now we're going to pay down the loan. And, if I'm a margin clerk and you don't tell me what to do, I'm going to pay down your loan. So that's $4,000. And now you have $6,000 in equity. That's the classical margin equation. I always want to see if perhaps I can't loan you more money. Now, this is where most people blow this one. If we look at this here, it looks like I'm going to say that it's $1,000 in excess equity, which is true. That's $1,000 in excess. But I told you this is the one time and the one time only. I'm actually giving you a credit for the half you could have had. So the answer here is going to be A, and it would be very easy for somebody to miss this with D. I wouldn't worry about this as a test issue. It's one of my pet peeves about how many test prep vendors spend way too much time on margin and turn you into a margin clerk when we have a margin department that does this for a living. All right, let me clear up our slide. Individual using fundamental analysis to select stocks would be most likely to analyze yes, it's oscillators. It's B, C, and D are all technical. So dividend payout ratio, how much do they pay as a dividend as compared to their earnings per share, right? So if the earnings per share was 4 and we paid a dividend of 2, that'd be a 50% dividend payout ratio. I would also know that we associate a higher dividend payout ratio with more mature, stable corporations. An investor opens the following option position Sell a 70 call at 6 and sell a September 70 put at 1. So I am selling two different type of options. So this is a short straddle. There's 4 questions about a straddle. Can you identify a straddle? A straddle is when you're long 2 different type of options or short 2 different types of options. The second test question is, can you calculate the break evens? Call up, put down. So it's going to be 77, 70 plus 7, strike price plus total premiums, and strike price minus total premiums, 70 minus 7, 63. So now we have a 50-50 because the break evens are either A or B, 63 and 77. The third test question is, where is it profitable? Short inside, long outside, silo, good mnemonic. So at 70, both contracts expire and I would get to keep the money, neener, neener, neener. So my max gain is 700. Now these are deceptive because on that call contract, once it goes past 77, I start to hemorrhage money. So I would know a short straddle has unlimited risk potential. So straddle is pretty straightforward on the test. By the way, just the answer there is B. My maximum gain is the premium. Anytime I collect money for an option position, the best case is contract or contract expire. I keep it, right? And this is the only strategy on 7 in which you have 2 break evens. I have a nice little 15-minute video called Score 4 More on straddles. I also, in the advanced option strategy lecture, have straddles. I have straddles everywhere. So if options, there's a whole separate options playlist on the channel with 20 videos on options. When an investor in a mutual fund elects to reinvest dividends, into additional shares, the price paid is, we have to let you reinvest at the NAV. We have to let you reinvest at the NAV, the net asset value. Definitely would know the NAV is calculated once per business day. I would definitely know that. Mutual funds, about 20 questions on packaged products. So make sure you're kind of hang on this. An investor is short 10 50 calls at 2.5 and short 10 December 50 puts at 3.5. Before expiration, ABC declines to 40-50. The customer is signed on his put position while his short calls expire worthless. A month later, he liquidates his long position in the 4. Wow. I'm going to make a note. I'm going to actually do this one on the Reddit. This is a fun one. So this is, I want to write down the QIDs. I can do this on the Reddit for people. 134 135 6922. Okay, so let me get my T fired up. A lot going on. I think this should probably be a churning question. But I like questions like this because I think it illustrates if you can track money, you're not fumbling around with, contract specifications, you're in pretty good shape. So I'm going to make a T and making a T so I can track money in and out of this account. Okay, so I'm ready now to kind of start tracking money. Okay, so I shorted the 50 calls at 2.5. Shorted, there's 10 of them. Now, by the way, I again do things on a per share basis. And then when I'm all done, I multiply because I think it's a mess to have $2,500 over here. So again, it's a buffet. Take what you like, leave what you don't. I like to do things on a per share basis. So there's my 50 calls. I might want to label that just so, I don't forget, what I'm looking at there. Those are my 50 calls. Okay, and then it says I short the 50 puts at 3.5. So let's put that in there. Whoop. And again, I'm just tracking the money here. And those are my 50 puts. Okay, so it says before expiration, the stock declines to 40.50 and I'm assigned on my put. So now what I got to do is say, okay, so I get assigned on my put. I had an obligation to buy the stock at 50. So I'll put that in here. Boom. I'll put that in red for dollars out. So it declines to 40.50 and I'm assigned on my put. So that means I had to buy the stock at 50. It says my short calls expire. So let's put that there. That could be a 0 or expire. I'm going to put that there. So I'm just tracking everything they're telling me that's going on in this thing. A month later, he liquidates the long position for 45. So, now they're saying I liquidate. So that 40.50 looks like it was kind of there to mess me up. And it says I liquidate the position for 45. So let's put that in there. And so now it looks like if I total up these columns, and that's what I'm going to do next. It looks like I'm out a total of, what is that, 40, 51? I told you I'm terrible at arithmetic. I'm not being facetious. So 2.5 plus 3.5 plus 45 is 2.5 plus 3.5 plus 45. It looks like that's 51. And it looks like I'm out 50. So I think I'm winner here. It looks like I'm a winner because I have more money in than money out. So I have a gain of 1 point. Now, remember, this is 1 point on 10 contracts governing 100 shares. That's called the multiplier. So that's going to be a gain of $1,000. B. A lot going on in that question. I like that one. I like that one in terms of illustration. I don't think it would be that messy on the test, but that's just, again, where the T in contract specifications, you should feel pretty good if you can get that question right. I'll probably say that, and then we'll get square this thing up and find out I missed it. How embarrassing is that going to be? Let's see. Let's clean up the deck here. Boom. Okay. Disregarding commissions, an investor purchasing 10,000 face amount notes at 98.2 would be expected to pay. So what I would do here is I take my calculator again, and you should definitely know the Treasury is at 30 seconds. So the 98, I think, is kind of easy. There's 10,000 face, so that's going to be 9,800 and something, right? So it's either A or D here. And then I'm going to take 12, divide by 32, 12 divide by 32. And then I'm going to times that by a bond point, which is 10, and I get 375. So the way I did that is I took the 12 divided by 32, and then I times it by a bond point, which was 10. In the case of a real estate direct participation program, non-recourse financing will be added to a limited partner's sales proceeds, have no effect on the original cost base. So if it was recourse, it would have an effect. If it's non-recourse, it does not. So in the case of real estate partnership program, non-recourse financing. Now here, I'm not quite sure if they're talking about the mortgage, but I'm going to say, since it's not in there, don't bring stuff into the question. So I'm going to say B on that, because I don't see anything in here that tells me that it's got something to do with a mortgage. So if it was a recourse note, that would add to my basis. So it would be C. On February 7th, the customer buys 100 shares of LMN and simultaneously writes a 35 call at 6. If the call is exercised, what will she report for tax purposes? And so again, for more often than not, the thing to do here is, kind of track the money. So I think what I would do here is I'd say, okay, I bought the stock for 39 and I sold the call for 6. I'm out 33, right? That's my break even. That's, what I'm out of pocket, and I get exercised. So that means I sold the stock at 35. So it looks like if I'm out of pocket 33, right? 39 minus 6, 33, and I sell at 35, I got a $200 gain. So D. At 2 p.m. Eastern time, a customer has an order to buy GGZ at the close on the New York Stock Exchange. GGZ traded between 70 and 71 all day, and then after the last minute rally, it closed up 4 points. The customer should expect to pay A, the opening price the next morning, the closing price. C, the average price calculated. That's just out. It's just out. A is out. So we have a 50-50 between B, the closing price, or D, the price is near to the close as possible, at the floor broker's discretion. Now, remember, the floor broker represents the customers, right? So as a floor broker, I'm the one who executes orders for clients of member firms. So I think what I would expect to pay close to the closing price, right? So B. For a retired person, which of the following would provide the greatest protection against inflation? I don't like this question. I hate it. It's only comparison to other things that the variable annuity is the right answer. It's because, remember, the variable annuity is that mutual fund with an insurance wrapper. And so because of that mutual fund, the separate account or sub account, it would do better than perhaps these others. I'm not a, as you can tell, a variable annuity fan, but oh well. Municipal bonds offered for sale and the new issue market can be found in, again, this is a question about the bond buyer, a newspaper widely read in the municipal market. And that's where we publish those notice of sales. When recommending industrial development bonds, the registered rep would be remiss if they did not discuss the guarantees offered by the issuing municipality. This is where, again, it's supporting a private activity. The tax bracket of the individual and the alternative minimum tax. Yes. Remember, the tax bracket's always going to be important, but in an industrial development revenue bond, as I just mentioned, they're supporting a private activity. And the IRS says that means these can be preference items under the AMT. Speculative nature, that just makes no sense. Depends on that. So I'm going to say B there. The other one, by the way, would be public purpose, non-essential, like a stadium bond. All following may receive breakpoint disclosures. This is very much a test question. Investment clubs cannot pull their purchases for purposes of meeting a breakpoint. So it's C. Treasury strips are quoted based on 1/32 of a point in dollars, 1/8. You should know it's not 1/8 because remember, 1/8 is for corporates and munis on a yield to maturity basis or on an amortization of the premiums. So they're asking, how do you decide what you're paying for a treasury strip? Remember, that's the government version of a zero coupon bond. And so you're going to quote these on a yield to maturity basis, C. An investor opens the following positions. I sell short 100 shares at 72, and I buy a 70 call at 5. I am a smart guy. I am a smart bear because I know that if I don't buy that call, I'm going to be subject to unlimited risk. So again, lots of ways to do options. Dean uses T's. I like to track money in and out. So there's my T. And I'm just going to track the money. So I sold short at 72. So that's going to be money in. So I'm going to just put that over here. And then I'm very smart because I said, you know what, just in case, I'll establish the choice to buy back the stock at 70, and I paid 5 for that. And so, when they offer you break evens, you can just plug it in and say, okay, what number makes the columns balance, right? If I plug 67, so if I sell short the stock at 72 and I buy it back at 67, indeed the columns would balance. I'll just show you that, right? So they're offering me 67 as a break even, and indeed that does make the columns balance. So that is certainly the break even. Now, the reason that's helpful is because now I know it's either this or this, right? Because I got the break even. The maximum gain. So I want the stock to go to 0. I want the stock to go to 0. And so maximum gain is 300. No. The maximum gain is when the stock goes to 0. And, I buy it back for nothing. So the answer here is A. Maximum loss. Well, I can buy back the stock anytime I want. Let's just show that to you at 70. And so the worst case is, yeah, I'm out 75 and brought in 72. So just illustrating again that the answer is A. Smart bear. Let me clean that up. Convertible debenture has a conversion price. This is super important. You can't do anything when you get the conversion price. You need to establish the conversion ratio. So as a test taker, right away, the minute they say that, I say, hey, hold on, let me get my Conversion ratios. I'm going to divide par is 1,000, and I'm going to divide that by $40 a share. And I get my conversion ratio here, which is 25 shares. Now, I told you, not being facetious, Dean is terrible on arithmetic. So I'm just going to, that's called my conversion ratio. And I'm just going to check that. Yeah, so back in business. If the market value of the debenture rises to a 12.5 point premium over par. Wow. So 12.5 points. Remember, in a bond, a point is $10. So I'm going to take 12.5 times 10, and that's $125. So now they're telling me the bond is priced at $1,125. That is the current market price of the convertible. All right, so I need to have that. I think I'm going to need that. By the way, you want to practice, drill, and rehearse that you're, not fumbling around with what's going on. Which of the following are true? So I know Roman numeral 1 is true because I just did that out of the gate, and you should do that right out of the gate. So we know we need this one. And so that means it's either this answer or it's going to be this answer. All right, so parity. So the way I do parity is I take the current market price of the convertible. And so I'm going to take the current market price of the convertible, which is 1,125. I'm going to divide by the conversion ratio. And that's going to give me parity. So I'm going to take my calculator, 1,125, divide by 25 shares, and parity is 45. Listen, you got to be able to do parity on the test. You can't be fumbling around with how to do parity. And so now we've established that that's 45. So it's 1 and 4. 1 and 4. That's definitely something you're going to have to deal with on your exam. All the following statements are true of the special memorandum account, except I think of the special memorandum account as a holding tank for your excess equity. And so it is a line of credit that you can have as cash. A is true. You can use it as cash, or you can use it to buy additional securities. B, the SMA may be used to meet the Reg T requirement. Yeah, if you have SMA, you can buy stock and not have to come up with additional money. That's true. SMA in a long margin account decreases when the market value decreases. No, that's the whole point of making the special memorandum, so that it doesn't go back down. It's a holding tank. If I didn't do that, you'd be using it in a way that might not be in your best interest. Non-required cash deposits generate SMA. Yeah, because as a margin clerk, any cash coming in is used to pay down your loans. So C. The interest municipal securities pay. Now, without telling me where you live and what kind of bond you're buying, I can only tell you they're federally tax exempt. Whether they're state, local, or federal, or state and local, I need to know where you live and what kind of bond you're buying. I need to determine suitability. 2 friends would like to open a joint account, but have the tax filed under the name of the non-employed individual. Joint account, but have the tax filed under the name of the non-employed. This could be done. This sounds kind of funky. This sounds kind of funky. Yeah, I think the best way to do this would be, I don't like it. I don't like the question personally, but I'm going to go for B. Ideally, I would have both there, but I'll go for B and see if I got that. Account opened as a partnership. No, that wouldn't be right. That's just not right. So I'm now doing process of elimination. A tenant in common with the percentage ownership in the name of the designated person. A joint account with TOD, transfer on death, avoids probate. B seems like my best choice there. Which of the following is required to sign a new account form? It's always the principal signs a new account. I get lots of people in Series 24 classes because they're accepting accounts. It's B. Changes in payments on variable annuity most closely fluctuate based on the changes in payments correspond most closely to. I'm looking for, by the way, the assumed interest rate, but I don't have that. And so the closest thing to the assumed interest rate would be the value of the securities in a separate account, and now that it moves it based that. So I'm going to go for C. I'm looking for an answer that's not there. So, when you're looking for, answers that aren't there, then you got to say, okay, well, what answer is closest to what I'm thinking? I'll go for C. Which of the following is not a requirement to be included in a customer confirmation by the MSRB, whether we acted in a principal or agency capacity? Absolutely. That's called capacity. I say, listen, in some transactions you do with us, we're going to act as your agent and get the muni bond elsewhere. But in other transactions you do with us, we're going to be acting in our dealer principal capacity, and you'll be buying and selling the muni bond from our inventory. So that definitely is disclosed. The amount of the dealer's markup or markdown, the accrued interest, certainly, right? The accrued interest is calculated from the last interest payment date up to, but not including settlement, is paid by the buyer to the seller. So it looks like my best answer here is C, because I'm certainly going to disclose capacity. Either in our broker agency capacity or dealer principal capacity, I'm certainly going to have the accrued interest there. Without any position on the stock, an investor wrote a July 60 put at 6. An expiration, it's selling for 66. That's important. So that means that the put expired worthless, neener, and I get to keep the $600. So here says I wrote it, so I'm a happy camper here, right? I'm a happy camper. It's a 60 put, it's stock 66, so it expires. So I have a short-term capital gain. Now be careful, it's going to be taxed at ordinary income tax rates. So it's easy to miss this with a B, but it's actually a short-term capital gain at 600 that will be taxed at ordinary income tax rates. All options trading is short-term with the possible exception of a leap, because that's the only option contract you could possibly hold for more than 12 months. Remember, you have to be a risk. Technically, leaps go out to 39 months and practice 30 months. And I would be prepared for a question about a leap. A customer buys an XYZ October 75 put at 7 when the stock is 72. The stock falls to 69 and you exercise the put. For tax purposes, the sales proceeds are. So again, I told you for the most part, cost basis on tax purpose kind of questions follow break even. So 75 minus 7 is 68. So when I get exercised, the sales proceeds are going to be that $6,800, right? I paid $700 for the contract. I got paid $7,500 for I sold the stock at $7,500, right? I exercised the put, so $6,800. So for the most part, tax questions on options follow break even, so $6,800. Which of the following is not eligible for 403B? Yeah, not the student. You're definitely going to get who qualifies. It's not the students. It's people who work for either the educational institution or the 501c, the charitable organization. They're using tax sheltered, means they're using pre-tax money. They have a zero cost base, so everything coming out is taxable. A customer buys one August 50 put at 1 and sells an August 65 put at 10. The maximum potential gain is, so you need to recognize this is a credit spread, right? I brought in 10 for the 65, paid out a 50 put. I'm pretty smart, by the way, because I'm saying, okay, well, just in case, so I collected $900. So whenever I collect money, the best case is I keep it. So I'm hoping XYZ is 65 or higher. The contracts expire worthless and I keep $900. Now, by the way, you're a jerk of a customer. You say, Dean, had I done the 65 puts, for 10, I would have made $1,000. I go, yeah, but you would have had all kinds of risks. So, here the worst case is, you make 900. Worst case is you lose 600. Worst case is somebody sticks it to you at 65 and you stick it to the next guy at 50. This is a credit put spread. This is bullish. DMF bond is convertible in 25 shares. That's nice. They actually told us the conversion ratio. Remember, sometimes we have to solve for it, but here they're actually telling us what it is. It says it is increased 20% above par. So what would you expect the price of DMF common to be? So I think what I would do here is figure out parity. And what I would think is it'd probably be somewhere, let's see, let's just do this. So 1,200 divide by 25 shares. And I'm going to get parity. Divide by 25 is 48. And so I'll just put parity there, parity of the common. And so now they're asking me, where would I expect the common stock to be? So if I buy this bond and I turn it into the stock, I'd be paying 48. And so, you know, if it's going to be, I would expect the stock to be somewhere in relationship to this. What would you expect? So which of the following would you expect the price of DMF's stock to be? You know, we're thinking it's being driven by the stock price. So it's going to be somewhere. I'm going to toss out 32 because that seems like the bond wouldn't be trading at a premium, because we don't think this is based on interest rates because there's no coupon. So since there's no, you know, coupon here, I got to think that that bond price has been risen due to the stock price. And I don't like to say that it's 48, but that's my best answer given this. I would want it to be, you know, say the stock is somewhere, you know, close to this, but, you know, there'd be some time value. That's something I'm struggling with here. But given that this is my answer set, it looks like that's what they're getting at is, again, this thing about parity. You're definitely going to have to do parity. I don't like the phraseology of this particular question, but, you know, oh well. By the way, my little egg timer just went off, so that means it's another 30 minutes. So if you're doing this in 30-minute chunks, by the way, you should practice and you're timing yourself, and you know, you want your brain to kind of know what 125 questions feels like. XYZ issue owns 18% of the voting stock of ABCD Enterprises. So immediately I hear this, I'm thinking to my mind, this is going to be a dividend of one corporation paid to another. That's what I'm thinking. Maybe I'm wrong, but that's what I'm thinking. Anyways, if the current tax year XYZ receives $250,000 in dividend income. So remember, this is, I think, looks like Dean is right. This is about this 50% thing. So I'm only going to owe taxes XYZ on 125,000 of that. So it says XYZ has a marginal tax rate of 21%. What is the tax liability on the dividend income received? So I'm going to recognize that there's a 50% dividend exclusion, and I'm going to take my calculator and I'm going to take 125,000. I'm going to times that by the tax rate of 21, and I get 26,250, and that is one of my choices. So again, I don't think you're going to have to calculate this. I just think you need to recognize that a dividend of one corporation, ABCD, paid to another corporation, XYZ, is 50% tax excludable. So 50% of the 250 is tax excludable. I don't owe taxes on it. That's 125. So that means I owe taxes on the 125. If a customer purchases a new issue of common stock from a syndicate member, the customer will pay the public offering price. Well, yeah, I mean, the public offering price includes all this stuff, right? So it's kind of deceptive here, but it's not plus a commission, and it's not plus the spread. The spread's built into that, right? That spread. The public offer plus markup. I'm going to go with no markup or commission. I'm not sure I'm going to get that, but that seems like the best answer there. A customer wanting to invest in an oil and gas partnership wants to know what her cost base will be for tax purposes. Well, there can be a number of variables. The cost base for a limited partner can best be defined as cash investment minus the distributions. In partnerships, we give you back your money. So you start getting a return of your capital. And so, yeah, A sounds pretty good. Recourse debt minus cash contributions. No. Recourse would add to the cost base. Non-cash contribution plus cash investment plus recourse debt plus minus. Now that looks as my good choice here, because recourse debt plus my cash does add to my investment. I may miss this because, you know, I always think of recourse. I don't think of it in the context of an oil and gas partnership, but that's true. So I'm going to go for D. Let's see if I get that right. It's either A or D. One of your customers has been regularly investing in the shares of an aggressive growth fund. The investor has a long-term time horizon and does not expect to touch the account for a number of years. In the event of emergency, federal law requires redemptions with proceeds. You know, this has nothing to do with all the stuff they set this up with, right? So it's redemption request. The investor has a line, in the event of emergency, federal law would require redemption. So it's within 7 calendar days. So federal law would determine within 7 calendar days. So I would prefer that says 7 calendar days, but 7 days. In order to sell a 3865 stop limit. So be real careful on these. So this is slobs over bliss, right? So sell stop, whether it's a sell stop that turns into a market or a sell stop that turns a limit, is below the market. And I'm telling my broker that if it trades at or through 3865, I want to sell, but then I want my price or better. So there's 2 contingencies qualifiers here. This is definitely, so we're looking for 2 things. Let me get out my annotation tool. We're looking for 2 things here. We're looking for a trade at or through 3865. And then we're looking for an acceptable price, which the seller is going to be 3865 or more. We follow the convention. It's below the market, 3850. So nothing happens here. Nothing happens there. Ding, 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 ding. It didn't trade at, it traded through. It didn't trade at, it traded through, right? So we're looking for a trade at or through. Oh, and 3850 is through. So that's where the order gets triggered or elected. It's no longer a suspended order. It's now a limit order. And this customer says he wants to sell it for 3865 or more, and 3835 is unacceptable because he wants more. So we would say it has not yet been executed. So kind of tricky one. Right? So in order to sell at 3865 stop limit, sell stops are below the market. So it's below wherever the current market is. The subsequent trades are 3885, 3850, ding, ding, ding. It traded through 3865. It's now live limit order, but the trade is 3835, and this customer says his price or more is a seller or more. Under Municipal Securities Rulemaking Board, a control relationship exists when the officers and employees of the broker-dealer hold positions and authority over the municipal issuer. Indeed. The officials of the municipal issuer hold policy-making positions of the broker-dealer. Sounds pretty good. The municipal issuer is a public finance client of the broker-dealer. The employee of the broker-dealer lives. It looks like 1 and 2 is the best answer here. Right? Common control. That's what that means. I mean, if I sit on the city council, I also underwrite bonds. The city goes to underwrite bonds. I go, hey, that's what I do. That's what I do. When calculating net investment income, the investment company includes DI 90, very testable, dividends plus the interest on the bonds minus the expenses. Boom, DI 90. I'd also know that REITs are very much the same way. They distribute 90%. Not, by the way, most do much better than that, but they're certainly going to do less than that. DI 90 is a good memory aid for that. Not losses, just gains, right? The only thing that flows through losses is partnerships. You have a high income client who wishes to maximize his after-tax interest income, which of the following may not meet your client's investment objectives. So I'm immediately thinking muni bond, but now I look and all of these are muni bonds, except one. So high income client wishes to maximize after-tax interest income. Might not be. I would know a municipal note is short term. And so I'm going to go for that because I would expect the bonds to pay more than the municipal note. And they're saying maximize after tax. So that's what I'm going to go with. Let's see if I get that right. I'm pretty sure that's the right answer. By the way, I'm also using the Sesame Street trick. One of these things is not like the other. Your client currently holds XYZ stock in her portfolio. You notice the put call ratio for options trading on XYZ has been increasing over the past several days. The increase in the year ratio would indicate, so people track that. And, you know, if there are more people are willing to pay higher premiums for puts than calls, that means people think the market's going down, more for calls than puts, market's going up. And so some people do track that. Now, I haven't had anybody on the test tell me they've actually seen this. Yeah, so what that means is that C, the underlying XYZ stock, more puts than calls are being traded. So the answer is C as in Charlie. A customer wants to open an account in the name of her adult son, wants the account to be approved for naked call writing. Her request should be refused because uncovered can only be written in margin accounts. Writing naked calls is not suitable for minors. Discretionary authority may not be granted with respect to writing naked options. By the way, I'm just going back to read the question. It's her adult son, and the customer wants to open an account in the name of her adult son, and wants the account to be approved for uncovered, should be refused. Yeah, I think D is my best answer. This sounds kind of wacky. I'm not sure what they're trying to get at as a test issue, but I think D is my best choice. Opening an account for a third party is prohibited without the consent of that party. By the way, it's stupid as well. Which of the following is not found in a municipal revenue bond resolution? The reporting requirements regarding revenues collected, A, the underwriting agreement, the conditions of the maintenance covenant, terms of the rate covenant. Well, remember, the underwriting agreement is between the issuer and the underwriter. So I'm going to go for B. That just seems odd man out, Sesame Street. The federal legislation that requires broker dealers to verify the customer's identity, that's the Patriot Act. I hate that we call it the Patriot Act because it makes it sound like if you have any problem with it, you're not a patriot. But that's the Patriot Act. It requires a picture ID, and it requires a process for closing accounts that we can identify the customer. Which of the following are characteristics of commercial paper? It represents a loan by the holder to the issuer. That's true. It's a certificate of ownership. It's commonly used to raise working capital. Indeed, that's true. So 1 and 3. It's junior to the convertible preferred stock. No, it's debt. It's senior. So it's 1 and 3. I would know it's issued at a discount, and I would know it has a 270-day max maturity. So make sure you know all those money market securities, commercial paper, bankers' acceptances used to facilitate foreign trade, T-bills, negotiable jumbo CDs. Customer buys 28,000 of ABC stock in April of some year. At the year end, it's $23,000. So we have a $5,000 loss. How much can the customer deduct? So now they didn't tell me about the rest of my portfolio, so I'm assuming this is my only position. And the most you can take from your portfolio in terms of losses against your paycheck, your unearned income to earned, is $3,000. An agent may open a joint account for which of the following? An agent is you. That's somebody who works for a broker dealer. Lee and his 13-year-old son, no. Mary and Kelly, 2 adult college roommates, yes. Jerry and Mark, friends and partners, and yes. Melinda and her minor nephew may open a joint. Melinda and her minor nephew were John, for whom she is the guardian. Wow, this is a convoluted one. We don't open accounts for minors directly, so unless it's not, there's going to be a problem. So here, I think the right answer is going to be 2 and 3, right? Mary and Kelly, 2 adult college roommates, and then the partners in business. So you can't open accounts with minors directly is what this question is getting at. So I'm going to say 2 and 3. If a customer buys an OEX, this is an index option at 5, and then sells it at 16. When the underlying index is, by the way, this has nothing to do with answering the question. It's strike price plus premium. So the strike price is $350 plus 5, and then sells, I got another thing going on here, so my bad, a $335 call at 16. So now it's a spread. It's a call spread, and the way we get break even on call spreads is call add to the lower. So I'm going to take the net premium, which in this case is 11, and I'm going to add it to 335 plus 11, and I gave my break even of 346. Cal and push, call add to the lower, and a call spread, put subtract from the higher, and the put spread. I also would know that index options settle in cash. And I would also know that index options settle T plus 1 and exercises T plus 1. All the following activities in a customer's mutual fund may be considered a violation of the conduct rules, except switching A shares between fund families. That sounds like it's a problem. Excessive activity sounds like a problem. Granting discretionary authority to new rep. I mean, that might not be smart, but that doesn't sound like a problem. Short-term trading, yeah, C seems like the one that's not a problem. Or these are called the code of conduct rules. You definitely should know you're not supposed to do breakpoint sales. You're not supposed to sell dividends. A customer purchases a non-exempt security. That means it's not a muni, it's not a government bond. In a cash account for regular way delivery, Reg T requires the executing broker dealer to receive payment. We talked about this before, right? It's T plus 2, but plus 2. The customer under Reg T actually gets 2 additional days. And that is not about whether it's a cash or margin account. Cash accounts where you intend to pay in full, and margin accounts where you intend to pay part of the purchase price, doesn't matter. Reg T says they get 2 additional days. The customer relationship summary form is an integral part of Regulation BI. For an existing cash account who received the initial form of the customer relations summary in July 2020, the new form must be delivered no later than, so this is a relatively new thing. Yeah, I think the opening of the new margin account, remember, because we're making interest on the debit balance and we need to disclose some things. So I'm going to say D when we open the new margin account. So going from a cash account to the margin account. An investor purchases an ADR of a company domiciled in South Korea. I think Samsung should understand that any Korean taxes will be added to the US tax on those dividends. The investor will not be able to receive a stock certificate for that company. The ADR has greater market risk than the stock itself. Yeah, the won, right? You're going to have a foreign currency risk. I'm going to go for the investor would be subject to foreign currency risk. I definitely should know that in ADR. So I think that's what they're getting out here. It's not going to be added. I get a credit for whatever the Korean government keeps of my dividends. A customer buys a December 30 call at 7 and sells a December 40 call at 1. This looks like a debit call spread. 2 months later, they close the position for a net of 9. So I want the difference to widen, and to widen from 6 to 9. This is the hardest part to get, and here's an illustration of that. When I did the spread, the difference was 6 out. And now they're telling me I can close it for a difference of 9. And that means I made $300 because it's a debit spread. Remember, widening is a good thing. Widening is a good thing. A customer is concerned about a possible pullback in XYZ stock. She instructs her broker to sell my XYZ stock if it falls to 40, but I don't want less than 39.75. So she's got 2 contingencies here. This is a stop, pull the trigger, make it a limit order. So this is a sell, stop, limit. A sell stop is when she doesn't specify the price, and that's going to be below the market. Once the IRS determines that a tax shelter is abusive, it can do all the following except charge interest taxes. Yeah. Charge the taxpayer. Yeah. The IRS doesn't usually throw you in prison. They refer you to the Department of Justice to do that. Disallow all your deductions. I'm going to say they can't throw me in prison. I'm not sure I'm going to get this right. But that they would refer you to the Department of Justice. So, the IRS isn't the one who actually throws you in jail. They refer you to the Department of Justice. So I may miss that one. Let's see if I get that one right. I should definitely know A. I know A is true. I know B is true. I know C is true. So, and which of the types of offerings does a broker dealer have no financial obligation for unsold securities? You should definitely know that best efforts is true. So I need something with a 2 in it. You should know that standby underwritings are a type of firm commitment underwriting used in rights offerings. And so I should eliminate anything with a 3 in it. So let me just get out my annotation tool. I'm using process of elimination here. And what I'm going to do is get rid of, I know I need something with a 2, and I can get rid of anything with a 3 because I should know that that's going to be, hey, look at that. Is that helpful there? Boom. Standby underwriters are used in rights offering. They're a form of a firm commitment underwriting. So by process of elimination, Dean has determined that it is D. Let me clean up my slide. All along may be found in a money markets portfolio, except, boy, this is a layup. You don't get many as easy as this, right? Common stock, that's not a money market security. Oof. One of your customers has recently celebrated a 58th birthday. The customer began a regular investment program into the shares of the Capco Growth Fund. I think this sounds like dollar cost averaging. The account is showing a substantial gain. Because retirement is getting closer, you suggest she use the exchange privilege offered by the Capco Fund Group. Your recommendation is place half the holdings in the balance fund. Following this recommendation, you should know that when you go from Fund A to Fund B, it's going to be a taxable event. Now, she recently celebrated her 58th birthday, so that's important. I'm just seeing if it's in a retirement plan. I don't see any in here. It's in a retirement plan, but it's not in a retirement plan. There's going to be no penalty, right? So I'm just checking to see if this is an IRA or 401k. I don't see anything like that. So I'm going to say D. The 10% penalty would be if there's a retirement plan involved, and I don't see that anywhere in this question. A married couple hoping to retire within the next 5 to 10 years, 5 to 7 years, has expressed having a low risk tolerance for the stock market. They have combined income of 350. Given this, which of the following mixes would be most suitable? Well, they're in 350 sounds like a lot. I'm going to say, given this answer set, low risk tolerance, I'm going to toss out B, partnerships, direct participation programs. Let's see, retire at 5, they have it combined. Treasury bonds, corporate bonds, preferred stock, treasury bills, common stock, options. They told me they don't like stocks. So it looks like I got a 50-50 here. I got a 50-50. I'm making the assumption here that that tax bracket is high enough that I should have some muni bonds in there, that 350 in income. So I'm going to say I need some muni bonds. And that means I got to take A, and I'm tossing out the common stock and I'm tossing out the partnerships. So I'm going for choice A. A customer buys a bond, a municipal bond at 106. This is about 50% probability on the test. When you buy a muni bond at a premium, you have to do straight line amortization downward. I call that decretion. That's just team. Some people call it accretion. I call accretion going upward. So I am going to lose $60 over 8 years. So first thing I'm going to do is take my calculator. I'm going to take 60, divide by 8, and I find out I should be writing down my cost base by 7.5 each year. Right. So I got that by taking the 106 in bond speak. That's 1,060. And now it says that I've had the bond, let's see, for 4 years. So I'm going to times that by 4 years. And when I do that, I get 30. So if I'm writing it down, it says, what is the amount of the unamortized premium at the end of 3 years? The unamortized premium. So 4 and 4, it's 8. So it's $30. No matter how I read that, it's going to be $30. 38-year-old, that's a 30-year-old investor places $25,000 into a single premium deferred variable annuity. Remember, that's after tax money. 22 years later, 38 and 22 means they're over 59 and a half. It's valued at 72. So they don't owe taxes on the 25, but they have not yet paid taxes. I'm going to take my calculator, 72,000 minus the original cost base, which in this case is 25,000. And so there is $47,000 they haven't paid taxes on yet. The investor surrenders the policy. If they're in a 25% marginal tax bracket, the total tax liability is, I'm timing that by 25%. So I took the 47 grand, which is the difference between this and this, right? Because that's money that hasn't been paid taxes on, timesing that 47 grand, whatever it was, and I'm coming up with choice B. Purchase or redemption order from an investment company must be executed at a price. This is called forward pricing. It's based on the next calculation of the NAV. The next calculation of the NAV. It's called forward pricing, very testable. And so it's going to be the next calculation. And remember, they have to do that once per business day. All the following statements are accurate interpretation of FINRA's conduct rule. Remember, that's the ethical behavior that broker-dealers and agents owe customers, associated persons. All retail communications must be filed with FINRA before first use. That's not true. Institutional communications need not be pre-approved by a principal. That is true. Sales and product promotion materials distributed to registered rep and other employees are retail communications and must be submitted for FINRA review, even though such materials are not intended for public distribution. All communications with individual clients are considered retail. Oh, because remember, correspondence is not considered to be retail communication. We definitely know correspondence is 25 or fewer in a 30-day period. Retail communication is 25 or more. So we should know that this is B, right? Institutional communications need not be pre-approved by a principal. There's proper training procedures in place. An inverted head and shoulders pattern. You should definitely know a head and shoulders pattern is a signal of a reversal. And a head and shoulders top, this is a bottom, is the end of the bull and the beginning of the bear. So this would be the end of the bear and the beginning of the bull. So a reversal of a downtrend would be the inverted head and shoulders. So I would definitely know the head and shoulders pattern on a chart is a signal of a reversal. Top head and shoulders is the end of the bull, beginning of the bear. A bottom or inverted is the end of the bear and beginning of the bull. A senior official of an issuer learns that non-public information was disclosed to an institutional shareholder of an issuer. This is called selective disclosure. It's a big no-no. This is called Reg FD. An analyst, to avoid violating Reg FD, the issuer must do which of the following. What you do is file an 8K within 24 hours. So promptly disclose the information is reasonably practical, but in no event after the later of 24. No. Promptly disclose as soon as practical, no event later than 24 hours or the start of the next trading day. Nothing be done. You should know that's it. So disclose the selective disclosure. It's either going to be A or B. So one says the start of the next trading day on the New York Stock Exchange. And choice B, it seems, says wherever their market center is, whether it's New York or NASDAQ. And so I'm going to go for B because that seems to be a better answer than A. But 24 hours is testable, and it's called an 8K. Well, it looks like that's going to be last time our 30-minute egg timer goes off. So it looks like this is coming in a lot longer than our usual fare. But people on the channel like practice tests, so I'm more than happy to provide them to you. Corporate bonds that are guaranteed are guaranteed as the payment of principal by another corporation, usually the holding company. But yes, that's true. So this is A. You're going to get tested on types of bonds. I have a lecture called Ford Bond, not James Bond. I highly recommend it. If there were truth in labeling, this would not be called the stockbroker's test. It would be called the bond broker's test. There are way more questions on bonds than stocks. The dated date is the date the bonds start to accrue interest. By definition, that's a good flashcard kind of to make. The date on which the bonds begin accruing interest. It's typically that first period, but I actually think of it as the coupon payments too. All the following are characteristics of Section 8. Section 8 is low-income housing. And you should definitely know low-income housing has some tax advantages. Yes, you should definitely know. I would have done this by process of elimination. You should definitely know that you're used to finance subsidized housing. You should definitely know they're also known as public housing authority or national housing authority bonds. And they have the full faith and credit of the United States government. That's very testable. That and Ginnie Mae's, remember, definitely know that. So by process of elimination, I would have gone for A. They're not a type of GO. When I lecture, I kind of call them platypuses. They're neither fish nor fowl, right? They're kind of in their own little category. Debt instruments put up for auction by the US Treasury that offer intermediate maturity best describes intermediate maturities. Well, we have short-term and long-term. So I'm going to go for Treasury notes, because if it said short-term, I'd say Treasury bills. And if it said long-term, I'd go Treasury bonds. So I'm going to go for Treasury notes because that's in between the two. All right, let's see how we did. Unanswered. How did I unanswer on it? This is a list of questions that have not been answered. Or we're submit incomplete. Did we miss 8 questions? Oh, what I do, forget to hit the button. I would have put a hedge fund. That's not. Let's answer that one. Yeah, I think there we go. Okay, so we missed a couple. Let's see what we missed. Let's see. We missed. I said an individual designated to act on behalf. I don't even remember answering this one. Institutional communications. I don't know if we just skipped this one. Oh, well. Maybe I missed. It's saying that I answered A and it's D. So, okay. I'll take that. I'll take that. 24. I don't know how we missed purchase of put. Did we answer it? Looks like we left it unanswered. So this is on me, I think. 24. I didn't answer that one. I don't know what happened. We did answer that correctly. So I don't know why it's doing that. Then we got that right. So I don't know what it's doing. It's actually just reviewing everything. So let's go back to our. Let's see what happened to that. Well, we got 95%. I'm not sure what happened. Well, it looks like, ladies and gentlemen, I apologize. It looks like for some reason it took us away from the screen for that. So, but we got most of those answers that were correct. So if you find one you think I did wrong, just put it in the comment box and we will go over it. I hope you found that helpful. Let me know in your comments. If you'd like me to do more of that, I'm happy. This will make practice test 5. And I'm just seeing, it looks like I had 8 questions that weren't submitted. So I'm not quite sure I actually missed a bunch of questions. I think for whatever reason, I didn't hit submit. I'm just seeing what that would be in terms of missed questions. So yeah, that means we missed 8. That's right. So it looks like I somehow didn't answer 8 questions. So anyways, when you're going through this on your leisure, do it. It'll take me a while to timestamp it. And I'll have practice test 6 up at some point in the near future. And like I say, thanks for your viewership. The channel is crossing 475,000 views in less than 15 months. We have 5,000 subscribers. So thank you for your support.